of capital for the venture industry, obviously there's a lot of one-on-one personal venture capital. Many a father-in-law has given money to his daughter-in-law or son-in-law to start a business. And that isn't measured quite as precisely in our economy because it involves individuals. It's hard to measure, but most informal estimates would measure the amount of one-on-one personal investing in the venture capital space to be greater than the institutional investments. But we're not talking about that today. We're talking about institutions, and we're talking about the U.S. venture capital industry, which last year was maybe about a half of the overall global scene. Used to be 3/4, but that's changed too. So just some definitions in the beginning that we're talking about U.S. institutional venture capital. And we really have three brief objectives. This is reunions, we'll keep it light. We just talk a little bit about what venture capital is, and we'll use the VC abbreviation for venture capital throughout, what venture capital is and how it works. We'll try to look a little bit, is this a good thing or a bad thing? Good and bad for the people who participate in the business, and more importantly, good or bad for our broader society. And then I'll try to end with a provocative slide about what's coming in the future. In a second, if she hasn't done so, thank you, it's already done, I see. Dana has put in the chat room a great data source for some of the things we'll be talking about today. This is the 70-page National Venture Capital Association annual report for 2021. And also on that splash landing page where that chat link will take you, there's a variety of other data that you can download.
The Peter Wendell thing is on right now, but of course I have the noon meeting, I believe it is, with Victoria.
Now, that would be our hardworking former PRINCO chair, Ed Matthews, I hear in the background. Ed, we hope you make your meeting. And, a dear colleague of mine, Ed, thank you for joining this morning. But anyway, I put up that link because for the scholars and the PhDs, there's a lot of good data there, and I'll reference that data. But the structure today, we're going to start at a very high level, simple conceptual level, and then we'll get a little more detail. I'll throw up some numbers, and then we'll move to a broader discussion. But with that, Dana, let's move to slide number 3. This is a cartoon that one of my students sent me years ago, and it kind of will hit on the essence of many things we're going to talk about. For those of you that are watching on thumbnail or on your mobile device, we have two cavemen back in the day. The shorter bearded caveman on the right, the world's first entrepreneur, chiseling the wheel, that great invention, the wheel, out of stone. And the taller venture capitalist standing on the left with his mouth open, like most venture capitalists, is telling the entrepreneur, oh, what a cool invention. How about I give you some venture capital? You give me part of the business, and I'll help you create a big, valuable company. We'll both own this together, and then we'll take it public. And boy, what a great invention. This will be for the whole world. It will make life a lot easier for humanity. All right, so there in one cartoon with a 30-second narration, you have the kernel transaction that drives all of venture capital. Let's come off screen, Dana. We can put that slide down and just come back to me. So what's interesting about that cartoon to me is, first of all, you notice the generous venture capitalist telling the entrepreneur he's going to give him venture capital. Well, the giving of venture capital is a very common phrase, but actually the venture capitalists don't give anything. They exchange money for a chunk of your business if you're the entrepreneur. This is an equity transaction. It's not a debt transaction. They don't lend you the money. They, quote, give you the money, which means they make an equity investment. They get a piece of ownership back. And then bodaciously, The venture capitalist feels they can make the situation better. Our tall caveman is telling the short bearded caveman, I'm going to help you build your business. I'm going to create a mutual success with you. Now, if you're a regular equity investor in the public markets and you go up and you buy 10 shares of IBM stock, you're not necessarily getting in the car and driving to Armonk, New York and helping the CEO build IBM. You're a passive investor. But venture capital is a contact sport, hands-on. And so when the one caveman tells you, oh, I'm going to help you build a business, then that's really the essence of what the profession is about. It's adding value. The venture capitalist also represents that he will help the entrepreneur get liquidity. He will someday make him or her rich, and that they're going to have a noble venture because they're going to bring the wheel to society. You can plug in other things that have occurred in more recent dialogues. So we're now going to talk, we're going to go through very quickly just 3 conceptual charts that shows what has to happen for this concept to really work, for what the tall caveman told the short caveman to work. So Dana, let's go to slide 4, which talks about in the beginning of any venture capital-based transaction, the founders, depicted by the left-hand circle, own 100% of their business. Those smart students I teach at Stanford every year, before they get in their car and drive up to Sand Hill Road to try to raise venture capital, those happy-go-lucky people own 100% of their business in the beginning. Now, if we move to the next slide, what has to happen for this to work is the venture capitalist has to make that little circle bigger. Because if the entrepreneur knows that at the end of the transaction, he or she is not going to own 100% of the company. In fact, in modern history now, the typical venture capital company that gets more than one round of investment, some get one and they're done, they don't work out. But if you get more than one round of capital, you typically get about 4 or 5 rounds of capital, and the venture capitalists typically own a substantial majority of your company. So this is what it looks like at the end of time. So then, Dana, let's go to slide 6, which juxtaposes these 2 slides. So for this whole venture capital thing to work, for the poor founders who owned 100% of that small circle on the left, they want to come out of this process with more square inches of value, if that's a concept, more square inches of value than they had in the beginning. And the only way they can do that, since they own a substantially smaller sliver of the pie, is for the pie to get bigger. It's very simple. I said we would start in a highly conceptual way. This is very simple. Okay, so that's what's got to happen. Now, one of the advanced questions that Dana sent me from someone in the audience was, gee, all right, if I'm looking, I work somewhere where we make institutional investments in venture firms, how should I be thinking about the venture firms I invest in? What makes a good venture firm? Well, one thing that's very important is that you get a venture firm that has the skill set to always make the pie bigger for the entrepreneur. Because if the pie can't get bigger for the entrepreneur, this is an irrational economic transaction. So you ask yourself, gee, if I'm looking at a venture firm, does that have men and women working there who have the requisite skills to help that little company, when they start to help that little company get more customers, to help them hire great people, to help them recruit a great board of directors, all the things that are important company building skills. The best venture firms and the best venture capitalists have those skills to help the little company. So I'll maybe head off one question from the Q&A. Now, let's in a second, let's come back to me and put this slide down. Now that we have the basic concept here of how this works in both cartoon and pictorial form, as well as graphic form, and who's doing what to who, and what are the key things to make success. In a second, I'm going to look at a more detailed chart that drills down into each of the three parties in the venture ecosystem. Now, most people, when you say venture capital ecosystem, most people think there's probably two pieces of that. There's the venture capitalists and the entrepreneurs that they fund, the two people in our opening cartoon. But actually, the venture capital ecosystem is driven by a third force, which is where everything begins. And that's the institutional investors that fund this ecosystem. The Princeton Endowment, the Stanford Endowment, the Yale Endowment, the Ford Foundation. This is where the money comes from that starts the whole ecosystem. So what we'll do in a minute is we're going to look at these three different branches of the venture capital ecosystem. The funds flow on the slide will be from left to right, and we'll just ask ourselves what's important to each of these parties, because by understanding what's important, we figure out where the pinch points are, where the leverage points are, and we might get some insights into the business, and we might better be able to evaluate how good a thing or not so good a thing this venture capital stuff is. So Dana, if you could put up slide 7 now. This is the tech runner today is who you might see on your screen is Winter Mead, who is he's our tech runner at our Stanford course. And this is kind of a core chart. This is required reading in the Stanford Venture Capital course before you ever show up the first day, because it really in one slide kind of gives the essence of the different parties in the venture ecosystem and what motivates them. So again, this is the institutional venture capital process. The funds flow is from the left-hand side of the chart to the right-hand side of the chart. So we start with institutional investors, limited partners. They're not limited because their intelligence is limited. They're limited because their legal liability is limited. Well, I see Andy Golden shaking his head. Some may have limited intelligence, but most of them, like Andy, are brilliant. They've made a ton of money in this field, but they have limited liability because the general partner, that's the men and women who run the firms, they have more liability. But we have limited partners on the left, then we have venture capitalists in the middle, and then on the far right, we have the entrepreneurs. These are the poor people who actually do the work, okay? The venture capitalists are at best the stagehands, and the entrepreneurs are the actors. They're the men and women that create the value. But let's just follow this chart here. This chart will be the longest chart of the presentation, and we only have about 3 more charts left, so we can afford to spend a little time here. So let's just look at what's going on with each of these parties, what they're trying to do to each other, and how this all works. So for the institutional investors, they invest in a venture capital fund. Now, a place like Sierra Ventures, currently on fund number 12, venture firms raise specific funds generally every 3 years. Some firms have specialty funds, and Andreessen Horowitz has raised 3 different funds in the last 15 months. But the limited partner invests in a fund. That fund is a long-term 10-year contract. The money gets called into the fund slowly. So the poor limited partners always got to do cash management, trying to keep cash available that might get called into this fund. That cash is sitting in the sidelines, certainly doesn't make a return in the fund. So it's not very efficient. And there's this huge illiquidity of a 10-year lockup. They pay these big fat fees and carried interest. And so they really, the limited partner needs an outsized return here to make this all pay off. Because why not just if you like kind of tech companies that VCs invest in, just put your money in the NASDAQ. They have a lot of tech companies. And we'll see in a minute what happens if you would have done that. But so the main thing, this is an ecosystem because this institutional investor on the left, they can really drive cyclicality throughout the rest of the ecosystem. If Princeton decides instead of having 14% of its endowment in venture capital, it's going to have 7%, and 15 other big endowments reach the same conclusion, then what's going to happen is the venture capitalists are going to have less capital, and the entrepreneurs will have less capital available to them. So the institutional investors, the limited partners, you don't hear a lot about them, but they drive this whole ecosystem. Now let's move to the venture capitalists themselves in the middle column. And she is depicted here with this chart, deciding which investments the venture capitalists will make. The institutional investors allocate capital to the venture capitalists, and the venture capitalists in turn allocates capital to the entrepreneurs. They pick winners and try to add value to them. Now, it's a true fact in the venture capital industry that basically less than 20% of the picks that the venture capitalists make account for well over 80% of their outcome. Most of the deals are not materially important to the venture firm. My wife, Princeton class of 77, has counseled me throughout my career to just do those deals and to come home every day at 4:30 and have a glass of wine and a leisurely dinner. Unfortunately, these deals are not known ahead of time, but it is a truism throughout 30 or 40 years of venture capital, in good times and bad times. A very modest number of investments totally drives the outcome. I talk in the next column a bit about slugging average as the appropriate way to measure a VC's performance, not batting average, it's slugging average. Did you hit a few long ones? In your whole career, you do about 5 good things and like you're well regarded. It's a great job, as long as you get those 5 good things. So again, these venture firms, so they're capital allocators. They try to add value to the things that they select to invest in. They're liquidity focused. They're like any person who walks into a theater. As soon as they make the investment, the first thing they start doing is figuring out where the door is, particularly if there's a fire, if capital markets swoon and they got to get out of there quickly. So venture capitalists look at liquidity, but they're long-term investors. And now the entrepreneurs here on the far right, these are the people that actually create the value. Hopefully the venture capitalists are creating value in how they allocate the capital. Hopefully they're creating value in how they attempt to help these businesses grow. But the men and women who run these companies are depicted on the far right, and they're by far the most important part of the ecosystem. They're trying to take great ideas, great products, fit them with markets. They're building their companies quickly. They're hiring a gazillion people. This is where the imprimatur of having a top venture capitalist as your investor can help as you're hiring all these people. And again, they're dealing with a capital source that more than half the time, they're not going to be very material to. So they have to have a certain charm about them to keep the game going. Because if I said earlier that the typical venture-backed company that receives more than 1 round receives about 6 rounds, then this venture capital raising process goes on about 6 times during the average 8-year illiquid life a venture-backed company would have before there's a public offering or some form of liquidity. Now, the whole game here in the lower right-hand side of this is a phrase we use at Stanford, and that's that venture capitalists never write checks to entrepreneurs unless the entrepreneur can get the venture capitalist greed to overcome the venture capitalist fear. Remember the structure of the industry. A few hits produces all the returns. FOMO, fear of missing out. The venture capitalist needs to create, the entrepreneur needs to create the capital systems that this deal that they are hearing pitched to them is the next big thing. And they better put their money in or they're gonna miss out on this 1 in 10 that would have otherwise made their portfolio of investment. So there's a lot more to say about this. And when we teach this at Stanford, there's a million charts behind it. But I think you get the essence here of the funds flow from left to right and of the key players involved. And with that, let's move to slide 8, where we're going to look at the volume of funds that moves through this flow. This is a long time series starting in 1990. So it's a 30-year time series. The lines are in billions of dollars. And this is venture capital disbursements. This is the amount of money each year that venture firms in the aggregate disperse to entrepreneurial companies. You may notice some interesting things. You may notice the tech bubble of 1999 and 2000, when suddenly 10 years earlier, the venture capitalist industry had been tiny, had been dispersing a couple of $1 billion a year, and suddenly it was dispersing $100 billion. That's the good news. Now, look what happened right on the other side of that. Within 2 years, the venture capital industry was back to dispersing $20 billion a year. But since then, it's been good times, up and to the right. Little stutters here or there, but basically last year, venture capital financings in the aggregate were about $164 billion. And this year, right now, they're on a pace to exceed that. We'll see. It's only first quarter data that's in. The real interesting thing is what's on the right-hand side of the chart that we can't see. And will this be followed by another drop, as you see in the 1999-2000 period, or will this continue fat, dumb, and happy into the future? We'll talk about that in a minute. But I just want you to see here the magnitude of capital. It's in the economic scheme of things, it's not that 164 billion is good, but the way our government is giving out money at the moment, this is some little rounding error if you're trying to stimulate the economy. But venture capital tends to be very regionally focused. So there's about 4 areas of the company here in Northern California, New York, Massachusetts, in particular, those 3 that get more than half the venture capital that's doled out. So this can be a big shot in the arm, especially since, as I noted on one of the earlier slides, about 70% of venture capital goes to payroll. Money goes into the company and they hire more people. So it's major, but in the overall economic scheme of things and compared to government stimulus programs, it's a drop in the bucket. Now, just come back to me, Dana. We can put this chart down. Just come back to me for a minute because I want to briefly introduce, we're actually doing pretty respectably on time here. I want to briefly introduce the next slide before I put it up because it's got a lot of numbers on it. And I just want to explain what we're going to be looking at because that one I won't linger over quite so long. But the issue before our august group is, hey, do you make any money doing this? Can it be good? And how much money do you make compared to other things you do? I was saying that the irrational institutional investor who invested in this category would insist on a premium because there's this long illiquid lockup and you got to keep the capital ready and you got to pay these exorbitant fees. So do investors really get a premium for doing this? And also, how does this compare to other asset categories you might invest in? And how sensitive is it to the time periods involved? We're going to look at average normative data. So what did the typical venture capital fund produce in terms of returns? I just want to say that these numbers, usually like in the stock market, you look, all right, how did the Dow Jones do or how did the NASDAQ do? And you add up all the stocks and divide. But here in venture capital, there's a much broader diversion of outcome from the top quartile performers to the lower quartile performers. If you hired 100 of the best public equity managers in the US, you might be a couple of point difference between how the top quartile does and how the bottom quartile. But in venture capital, the top quartile performers run circles around the lower quartile. And long-term institutional investors like a Princeton or Stanford or Yale or Ford, these people invest in the top quartile and they do very, very well. So now let's put up this chart, Dana, in slide 9 with that introduction. And again, this is going to show different periods of time, and the numbers are percentages. So that number in the top left-hand box at 50.1% says that the average venture firm last year for the 12 months ending 12/31/20 had a 50% return. So that's pretty eye-popping. But if you stay in that first column and you just let your eyes drift down to the NASDAQ, oh, by the way, the NASDAQ returned 43% last year, and you didn't have to tie your money up for 10 years, and you didn't have to pay exorbitant fees, and you didn't have to do a lot of other negatives that come with the venture industry. But, venture industry got its 7% return. Again, many of these numbers in the venture industry are not realized numbers. These are marks because some other clown venture firm funded it at a higher amount. I get to mark up my investment, okay? So whether or not these investments actually produce money and cash at these levels of valuation, time will tell. But other interesting things to note here is that, like, if you get out 10 years, for the venture capital industry as a whole, it wasn't a particularly great place to be, about 17% return, versus NASDAQ composite at virtually the same. And again, so that's not so good. But if you're in the top quartile of venture funds, the 10-year number is probably about at least 8 or 9 points bigger than that. And by definition, the institutional investor is only going to pick maybe 50 firms or so to go in. There's several 50 funds to go in. There's several thousand to pick from. So they really can produce and create a top quarter portfolio. But with that in mind, that, hey, this is pretty good. You look, the difference between the 20-year and the 25-year, that's that big bubble we saw back in 2000. The bubble numbers from 2000 are still in the 25-year numbers, but they're not in the 20-year numbers, okay? So again, this is very vintage year centric, because venture funds have some good years and they have a lot of years that aren't so good. Let's move now, Dana, if we could, to the next to last text slide, where we just ask ourselves, gee, is this good or bad, this venture capital stuff? And basically, for those who transact, for the limited partners, most limited partners have done very well in this field. If you look at Princeton's 10-year return for the endowment as of June 30th last year was a little over 10%, and their 10-year return in what they call private equity was about 17%. Private equity consists of PE funds and it consists of venture capital. But if you could divide that 17% number, the venture capital half of that would be much greater, not much greater, but substantially greater than the private equity side, well into the 20s. So if you get 10% in your base endowment, but you get 20% from the stuff you put in venture capital, then it's doing what it says. And that's generally been the experience of the long-term venture investors who get themselves into the top tier funds. The venture firms themselves tend to either do well or be gone. So that's pretty Darwinian. If they don't make a lot of money, then they don't cut their management fee in the next fund, or they don't cut their carried interest in half. a bargain venture capital fund is like a bargain brain surgeon. You don't go to them, okay? Because you wouldn't go to a cut-rate brain surgeon, all right? And for venture capital, if they've had to discount their fees because their performance is so crappy, you probably don't want to go to them either. So venture firms tend to go forward. If they're not so good, they go out of business. And for the entrepreneurs, most entrepreneurs who have had success at the hands of the venture capitalists will thank them. And most feel the venture capitalists did help make the pie bigger. Not every customer is happy in any industry, including this one. What's hard is for these parties to get to the elusive fair deal, because for the limited partners, as soon as the general partner starts to make very outsized returns, the general partner raises their carried interest. Now they're getting 25% carried interest. Or if they do super well, maybe they get 30% carried interest. And for the entrepreneur, it's always hard to know how much of your company to give away for what amount of money, because you don't know how your company is going to come out. For broader society, the venture capital ecosystem is extremely job creating. About 70 cents out of every dollar of venture capital that gets dispersed within 14 months, that's gone out the door of the company in payroll. And because this is geographically focused in a couple of areas, it's very meaningful to the economic region of Northern California, increasingly important to the economic region of Metro New York, and has always been quite important to the greater Boston, Cambridge area. What hasn't worked so well is who gets to play in this game. And venture capitalists tend to fund men and women like them. And venture capitalists themselves have not been a terribly diverse group. It's been a largely white male profession. I'll talk on the next slide. It's making progress. But this whole great ecosystem that's creating tremendous wealth for institutions and for the individuals involved is not an ecosystem that many parts of our society is playing in, and that's not good. It's being addressed, but it'll take time to address. We'll talk about it a little bit more in the next slide. Another issue for society is this favorable tax treatment that venture capital gets appropriate. Venture capital is, first of all, venture capital gains are capital gains. They're taxed as capital gains. Venture capital carried interest is considered a capital gain. That gets good taxation. Venture capitalists also have something called QSBS, Qualified Small Business Stock, which is a hugely attractive tax break, which basically gets rid of all federal taxes on certain types of venture investments in very early companies. And I think that tax treatment that's this favorable has probably no greater than 50% odds of being around a couple of years from now. On the capital gains side, venture capital investments are maybe somewhat more worthy of capital gains because there is huge economic value created than are capital gains given on people who are passively buying and selling stocks. And they're just trading with each other. They're not principal transactions that are building value. But if this continues to be an asset category that only certain people get to participate in, my guess is politically, the forces will not encourage the very favorable taxation that the industry overall receives. So I think the industry will become more broad in its participants, but I do think the taxes will not be quite as favorable as they are now. Let's move to the last slide because we're just about at time here. And in fact, we're a minute or two over time. But where is all this headed? It seems almost certain that venture returns will not stay at 50% a year. I'm kind of not going out on a big limb there. Okay. And this will revert to historic means, and the reversion will occur quite quickly, probably within the next year or two. Also, with the reversion toward means, some institutions will pull back. Now, obviously, when capital follows opportunity, so these are cycles. When the returns go up, the capital piles in, the returns burn out, the capital washes out. And that's kind of how the venture industry has been, and that's how it will continue to be. A number of people in the advanced questions asked about special purpose acquisition companies, or SPACs. A SPAC is a public entity that a promoter raises to attract capital for no specific purpose. And then the promoter tries to find an operating company to merge into the entity. These are currently very lightly regulated entities, and they often have a lot of interaction with the venture capital industry, because the product that the SPAC promoter tries to merge into is very often something in the venture capitalist warehouse. It's some company that hasn't gone public yet, hasn't been sold, and I can buy it into the SPAC, and then I will let Main Street participate in the venture capital world. So the pitch goes. It's not really that great, because there's a lot of promotion here. The SPAC promoter helping themselves to 20% of the profits after the venture capitalists help themselves to 20%. You got a lot of people at the trough. And more importantly, there's very little disclosure in these things. When you go public, normally you have to disclose a lot of things about the company, and you can't disclose other things. Like company can't sign up for a forecast with a SPAC process. You do sign up for a forecast. It's lightly regulated. I don't think this whole SPAC chapter is going to end so well. And my guess is SPACs will wane in popularity, but I do think there will be other efforts to let Main Street investors find paths into the venture capital industry. There's some projects going on currently with tracking stocks, where you would put money into a pool, and that pool would become a limited partner of some of these firms, but there'd be a buffer in there, so regulatory wise would work a little better, who knows. But my last comment here is that the VC ecosystem, both funders and those they fund, will continue to move toward greater inclusivity. And I feel that because in our society, whenever it's become apparent the power of an industry to create gain and good, it's had to open up to others. Look at places like Princeton and Harvard and Yale. 50 years ago, they were not very diverse. As it became more and more clear what it meant to get a degree from one of these places and how that could change your trajectory, the trajectory of your family and your generations of your family to come, Princeton went from being a white male place to now having, first of all, half female, secondly, 40-odd% people of color, more than 20% first generation college, a huge shift in the demographics, because the power to drive opportunity was so clear that others found a way to become part. And the men and women running the institution saw the wisdom of opening it to others. There will be a similar move in this venture financial ecosystem, because it's creating so much value. It's creating so many interesting companies that we need to let more people participate, or it's not going to last. It won't last politically, it won't last tax-wise. And it's also obviously the right thing to do. So with that, let me finish my comments, and Professor Sims, I think, will moderate Q&A. Chris, I think you're on mute. You have to come off mute. A mistake I make daily. There we are.
There we are. So I'd like to remind everybody that you can use the raised hand feature. I don't see anybody with a raised hand, but we have quite a few questions that have come in on the chat line during the talk. So why don't we start with Joshua Atkins' question, which is, do the overall return numbers change dramatically in particular sectors, or are they more or less the same on average? He's interested especially in whether healthcare has been more challenging to generate returns in.
Yes, that's a thoughtful question. Healthcare has typically been between 15 and 25% of total venture capital activity. It varies over the years. It comes in three flavors: biotech, pharma, healthcare services, and then also healthcare devices. So there's even subsections within healthcare. Generally, over the long term, up until a few years ago, healthcare was a laggard compared to information technology, part of venture capital. But they were both over threshold in terms of they were better bets than going into straight equity markets. In recent years, last year, if you look in that NVCA yearbook, healthcare investing, particularly in the biopharma side, really took off, and the valuations really went sky high. So the returns were almost as good. But the direct answer to the question is yes, over the years, there is a fair amount of variance. Over the years, generally, healthcare investing has not quite done as well as IT, information technology investing, but they've both been well over threshold, and almost any portfolio of VC funds, like we'd have at Princeton or Stanford, would contain both types of funds.
Tom Byrne has a question. Why don't you go ahead, Tom?
Hi, Pete. I guess my question is from, if you can look at it from the perspective of a limited partner, I'm curious if you have any view on what an appropriate asset allocation would be, say, for a public pension fund, and maybe as distinct, if there's any distinction to be made, from a major university endowment. Does it depend on the funding status of the public fund? And just a little bit of context. It's been 3 years since I've been chairman of the New Jersey Pension Board, but I had trouble convincing the staff to do anything for two reasons. Number one, we couldn't be too large a portion of any fund. And then they said, it was administratively difficult to, manage, a relatively small allocation for such a large fund. How would you go back to them? I still talk to them all the time.
Yeah, this is, Tom, that's an excellent question, because this is a debate in many boardrooms of pension funds, hospital endowments. Everyone struggles with this. And obviously, first, it's a decision that has to be made in the context of what your other assets look like. If you tell me that we're in 90% is in hedge funds, can we put the last 10% in venture capital? That's a little different question than, hey, we have a 65-35 allocation. We're wondering if we could carve off 10% and put it in venture capital. First of all, on the administrative side, it is a project, but as I noted in one of the slides, these days, limited partners often get their exposure to the venture sector by going through a fund of funds. There's these intermediary organizations. They select the funds. They monitor the funds. Some of them have been around for quite a long time and have very good access to top tier funds. Some of them are Johnny-come-latelys, and all they're going to get you is the industry average, which isn't very interesting, as we saw in those charts. But so administratively, most pension funds use an outside agent who has a fund of funds to actually do the selection, the monitoring, the capital calls, the distribution management. But very often in an otherwise balanced portfolio, a 10% allocation to venture capital can be a real good boost, but you have to be able to stick at it for years and years. You can't call the timing in the venture industry, because you're trying to guess how conditions are when you invest. And then if those investments on average are going to get liquid 7 years later, you're trying to guess how frothy will the stock market be in 7 years. Most people can't guess it in 7 days. So it's very hard to call the timing. You have to make a commitment and stick to it. Whereas a lot of these pension boards have people to turn over right? So it's even harder. The Tom Byrne comes and preaches for 4 years, and then your term is up, and you're just beginning up to bat in this asset category. So those are just some ways to think about it.
Fair enough. Good.
Thank you, Tom.
Bill Dudley had a chat room question. Do you want to deliver it yourself, Bill?
I'm curious whether you think the lessons of the pandemic are going to generate any lasting changes in the industry, or we're going to go back to sort of business as usual as the pandemic recedes.
Yeah, well, that's a thoughtful question. And, the first thing to note is business in the venture industry didn't change too much during the pandemic. There was about a 2 or 3 month dip in activity, but bingo, you saw the number of new dollars out. Liquidity was very good with all the public offerings. I do think that it gave venture funds more of a chance to roam, since there weren't the physicality. You have to go visit the company 20 times. Most due diligence was online, and it gave them to think even more broadly about the opportunity set. And there's some early evidence, and it's very early, that gave them a chance to think more broadly about the men and women they were going to fund. And that's the biggest issue that the venture industry faces, is broadening the opportunity set of those that get venture capital. And a precursor to that is broadening who's the venture capitalists, all right? They can't all look like white guys, particularly white old guys. So I think some opportunities, since we got rid of the physicality, to have more broad thinking investments and more broad thinking groups you were consulting with as you were making those investments. Hopefully that will last for the duration. And but in terms of the velocity of activity, it didn't really skip a beat, and the amount of liquidity, it didn't really skip a beat. So I think those things will persevere too. Thank you.
John Chiquitano has his hand up. Hope I pronounced the name right.
Good morning. Thank you. My name is John Chiquitano. I'm the founder of Pangea Ventures alongside Ni Loco, a Ghanaian Princetonian from class of 98. I'm class of 92. We, Pangea Ventures, supports African companies in the food and agriculture sector. And my question is about impact investing. Could you touch on the impact investing market, particularly in the US, and perhaps some trends in impact investing, perhaps including trends that concern frontier markets?
Yes, I think you're in a good spot. Impact investing has grown and continued to grow disproportionately, I think, to the industry. But it's not easy. What am I telling you? It's not easy. You're doing it, right? Because so many investors in the venture segment are looking for these outsized returns, and you have to convince them that I can get outsized returns, but I can also do a lot of good for the world, particularly parts of the world, for example, Africa, that are underserved. There is interest. I help a couple of wealthy families where there's multi-generations of families, and they want their venture allocation to contain this sort of socially important capital. And a lot of these areas don't have a lot of capital. They're underserved. So the supply and the demand ratio should contribute to outsized returns. It hasn't become a huge part of the venture industry. I'm not sure it ever will. But as the venture industry continues to grow, if ultimately 10, 12% of that 10% of the 160 billion put out last year, that would be a very meaningful set of activities and much larger than it is now. So I think you're in a good place, but it's not easy to make the compelling story about how the returns will follow in the way that the industry is noted for. So best of luck for what you're doing, because it's important.
Richard Rampell has a question. Would you like to deliver it yourself, Richard? You unmute yourself.
Can you hear me now? Hi, Pete.
Yes.
I saw you said hello to me before, and I was muted. I did answer you. So I'm kind of curious because there are a lot of companies out there. How do you decide who you want to invest in? I mean, do you look at management? What if people have just started up a company for the first time, or people that have a track record of starting up other companies? Can you just sort of describe what the due diligence is that you go through before you invest in one of these companies, these portfolio companies?
Yeah, let me give you a quick checklist, okay? First and foremost is what's the size and scale that the venture can get to be. If you go back to our caveman cartoon, you know, how big can that pie get? Because, you know, that bearded caveman could have had a nice little company making wheels, and he just, every time he sold one, he made another one, and it was great. But once you get the venture capitalists involved, you got to make a lot of wheels, and you got to get it big enough so that you can get a liquidity event out of it. So the single biggest reason most venture firms reject deals is because they're not big enough. They can't get to be size and scale that are going to make them one of those outsized deals that contributes totally disproportionately to their portfolio. After size and scale, then the issue is the uniqueness of what's being offered, the protectability. Patents aren't a big deal these days, but can the intellectual property be protected? Is the market overall that you're serving big enough? Are the men and women involved of high integrity? When you reference some of the successful, can they hire and attract the tens and hundreds of people they're going to need to make the venture? So those would be a key things, but they're all on the theme of, can this be big size and scale? Can I build a big business, or is it going to be very profitable, but an attractive little business, not right for big scale venture capital? That's the big knockout.
Thanks. Very helpful.
Okay, we're running out of time now, and so I think we're finished with the questions, and I'd like to turn it over to Griswold Center Advisory Board member Janet Clark for some closing remarks. Janet?
Yes, hi. I crossed over with Peter when he was a senior and I was a freshman, so we've known each other for over 40 years. And I know you're getting ready for your big major reunion next year.
Jacket.
You got the jacket on. It would be, and this is our reunion keynote address, and we appreciate you doing it. And it would be at this time that the 100+ people that have been on this Zoom call would repair over to Prospect House for a wonderful lunch. So we're having a virtual lunch, and a toast to you, Peter, for your excellence and your expertise, and also all of your contributions to Princeton University. Much appreciated, and thank you.
Thank you very much. Thank you to all the participants, to Professor Sims and to Dana. Thank you. Have a great reunions weekend, and we'll be on campus live next year. Great.
Okay, thanks.
Well done, Peter.
Thanks to all our listeners for joining today's event, sponsored by the Griswold Center, and to Pete for this terrific talk, and it generated a lot of great questions. There'll be a full recording of this talk posted on the Griswold Center's website if you want to share it with anyone who wasn't able to attend today. So thank you all.
Cheers.